Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to the show. This is episode 263. Corey, one of the fun things we do at our office in our morning meetings is we do icebreakers. And before we started recording today, you mentioned your icebreaker that you did, because I was actually playing golf this morning in a tournament like Superman. I went home, had lunch, said hi to my dog, took a shower, got into the office, and here I am working after I played golf this morning. So, but I want to share, let's do that icebreaker because it's a pretty funny one.
Yeah, my question for the team was, what is your go-to karaoke song?
And I'll answer since you asked. I'm not a big fan of karaoke at all. Mine would probably have to be some sort of rap song, so I wouldn't have to sing it. Probably like Today Was a Good Day by Ice Cube. That'd probably be my karaoke song. What about you?
I didn't know you had strong feelings on karaoke.
I'm not a big fan.
Okay, fair enough. Mine, I said, and I still stand by, mine would be Hooked on a Feeling.
Hooked on a Feeling. Have you sung that at karaoke before?
Yes, I have.
Nice.
Yeah, it was actually my bachelor party in Chicago.
Oh, I missed that.
That's where I sang that song most recently.
I was at your bachelor party, but I must have missed that.
Yeah, it was a little later at night.
That's good for you. All right. So again, for today's topic, we have several articles that we want to go over in headlines. This has been a lot of fun. We did that on episode 262 for the first time, and we will keep it rolling. So Corey, let's dive right into it. So the first article, and I've got it down here on my laptop, so if you see me looking down, that's what I'm looking at. I thought this was awesome. This article in the Wall Street Journal says, now that we're retired, it's time to move to Kansas. Did you see this one, Corey?
I saw that.
I just added it. So I don't know if you saw it. Did you read the article?
I read it this a few days ago.
So it's a great article.
Today.
Yeah. So it's about a real life situation. It's a husband and wife. They've been going back to rural Kansas for 50 years with their family for, family reunions or get-togethers. They currently live in urban San Francisco, where, many people know I think that might be one of the highest priced cities to live in. There's obviously a lot of people. It's a whole lot different, Corey, than rural Kansas. And I really enjoyed the article because the husband made good points about, Kansas will be simpler, it'll be cheaper, it'll be easy to live, we can find a new community, kind of slow things down. And then the wife made good points that there's still a lot in San Francisco that we haven't done. We really enjoy going to baseball games. We like going to museums. We want to be more active in the community. And the takeaway for the article was one of their friends gave him advice that said, you will know when you're ready. And it doesn't sound like you're ready yet. I think these people are approaching their 70s. Maybe they're in their 60s. But so I thought that was pretty cool. And I think that's good for our listeners and our audience to know that, hey, if you're thinking of downsizing or moving across the country, it's great to make plans and to think about that. But I don't want our clients to force it. Ultimately, you'll know when you're ready, and when you're ready, go for it. Corey, do you have any thoughts on this?
The only thought that I have to add to it is aligned with a lot of conversations I've had with clients. You probably have too, Jake, where clients will plan to retire at a certain age. They're in the financial position to be able to do it. But I've seen it many times where clients, they kind of get there and they're like, I just don't know if I'm ready yet. And even though they're in the position to do it, and what I find so interesting about that is more often than not, those are the people that, just like this couple in the article, they know when it's time.
Yeah, it's awesome. So I thought that was good. And I thought it was cool that they brought up Kansas.
Yeah, that's right.
Which is
that's
good.
Right. I wonder, where were they traveling in rural Kansas? Do you know?
They didn't say. Maybe they didn't want to, but they said they were close to a major university. They said they were in the Flint Hills.
Okay.
They said they were near a major university hospital. So I would guess near Lawrence. I would say, if I had to guess, probably somewhere near Lawrence, if I was guessing.
Yeah. And I feel like Kansas can get a lot more rural than that, but
Yeah.
to your point.
Well,
Yeah.
compared to San, and they weren't talking about,
True.
I think it was like a suburb of Lawrence. It didn't sound like even in Lawrence necessarily. So,
yeah.
All right, good. All right. So I double dipped on you here because I wanted to add that one in here late. So my next one is the good reason why the unemployment rate went up. So for many of our audience, they may or may not know this, but unemployment has, I'll use the word jumped as a joke. It's jumped from 3.5% to 3.8. This article was in Yahoo. Actually, I'm subscribed to their newsletter on LinkedIn, and I'll just read some of it here and then we can talk about it. But it said last week, Fed Chair Jay Powell said that a monetary policy response, and that's in quotes, may be needed if the jobs market didn't cool down. Basically, that's an explicit threat, Corey, that he's going to raise rates again. But the August jobs report out, this is last Friday as of the recording of this, showed more signs of cooling despite the headline numbers of new jobs being higher than expected. And one number stands out of Friday's report is the rise in the unemployment rate. And it rose unexpectedly, like I mentioned, to 3.8% in August. That's the highest level it's been since February of 2022. And so basically, Yahoo Finance, they said that this is actually good because it's not from people necessarily getting laid off or fired, but rather because more people looked for work. And so Yahoo has a chart that we may or may not put on the screen. So basically it says, according to this, there's two categories of people going back to work. It's the 16 and 19-year-olds, and the 55 plus crowd are looking for jobs. And then there's Bill Adams, who's Comerica Bank's chief economist, noted that participation from both immigrants and Americans with a disability rose significantly, the latter to a record high. And so it says, for an economy that's been suffering from overheating and high inflation, all of this seems like good news, or at least better news than an 18-month high in unemployment might sound at first blush. The labor market is slowing down, not collapsing, said Nick Bunker, head of economic research at Indeed's hiring lab. The labor market was sprinting last year, and now it's getting closer to a marathon pace. A slowdown is welcome. It's the only way to go the distance. So this is a weird phenomenon, but when you want inflation to cool and the Fed to stop raising rates, seeing that unemployment number go higher, Corey, is a lagging indicator and tells us that what they're doing is working, and hopefully they don't need to keep raising rates as aggressively as they had. It's a lot of information. What are your thoughts?
It is a lot of information. I think that, one thing that wasn't pointed out in there that I find really interesting, though, about the jobs numbers and the unemployment data is that when those reports come out every month, they're also going backward and they're revising prior months. And, there's been some months where they've revised the number up or down by 80 to 100,000 jobs. So that's a pretty significant number, especially if the number of jobs added is, 150 to 250,000. But the point the reason I bring all of this up is just simply to say that these data points that we evaluate and that we're looking at and paying attention to are important because it's what the Federal Reserve is paying attention to. And they're ultimately making decisions around interest rates using this kind of data, which is why it's important for us to understand and evaluate, but also just to understand the line of thinking behind how unemployment rising would ultimately be a good thing, like you said, Jake.
Good.
Because it just seems so counterintuitive.
Got it. All right, Corey, you're up.
All right. So the next report that I have that I wanted to talk about here, Jake, really there's a few accompanying charts, but this comes from Strategas, which is a research firm that we subscribe to and have access to. But the specific charts that they included in this was evaluating corporate earnings from the last couple of months as companies have been reporting their second quarter earnings here in the third quarter. They were evaluating what executives are and are not talking about on earnings calls. What I found interesting, and I think it's interesting to look at this data each quarter, is that the recession discussions, basically the topic of a recession, is back to the lowest that it's been since April of 2022 on S&P 500 company corporate transcripts. And the note that is really relevant here, I'm going to read it off of my screen, is that the mentions of recession fell sharply during the month of August, which is helping to ease the concerns of investors. Because a labor market that remains tight, which is what you were talking about, Jake, and additional income from higher interest rates that people are earning on cash are two contributing factors to consumers' resilience, I should say. So if the Fed has reached the end of its hiking cycle, the additional benefits that all of us may have from earning more interest on our cash basically could be tapped out, and that just makes the labor market figure that much more important. But I thought it was interesting that the discussions around recession have slowly trended down in 2023 from the perspective of corporations, along with inflation. Inflation has continued to fall, and shortages was the last data point that they highlighted too, that shortages are virtually back to the pre-COVID levels, basically saying that the inflationary impact of shortages that's existed for the last several years has largely cleared out. And I just thought it was really kind of funny, if nothing else, Jake, that they made the point that there, other hiccups could occur that could be used as excuses in the interim, which is just interesting to hear how, some companies may pay attention to other companies' earnings calls and use some of the same language. Any thoughts on that?
Yeah, no, not really. Again, the language, I think it's interesting, and I'm glad that you shared it. But you're right; these people do use excuses, and it is cool that they're not using the word inflation or recession as much. But like you said, I think they'll just come up with whatever they want. Sadly,
Little herd mentality there, I think.
Yeah, perhaps. All right, good. So with my next article, I've got where to put your cash now for every income level. This is another one I squeezed in there, Corey. Another article by the Wall Street Journal. And I blame you for this. You've got me turned back onto that newspaper. So I get a lot of emails from the Wall Street Journal now. But this is a good one on personal finance. And a lot of this stuff is no-brainer. It talks about, if you're living paycheck to paycheck, first thing you want to do is pay off your credit cards. And then if you've got some money to start building up in your checking account, look to make sure your bank is paying on your cash, and consider switching. Again, today, if your bank's not paying 3, 4, 5%, I would look at potentially switching. Then you can look at high yield savings accounts. These are typically online. Again, you want to make sure that they're FDIC insured and that they're safe institutions. And then you can also look into certificates of deposits or CDs and treasury bonds. All these things are yielding 3, 4, 5%, Corey, which hasn't been a thing for the last decade. So I think now it's very important that our clients and individuals manage their cash, because it wasn't really something that you had to pay attention to the last decade. What do you think?
Absolutely. Yeah. And I think it's, rates have been higher now for a while, Jake, but I think that, these types of stories and these discussions that we're having we're just having them more and more, because again, there's a lot of people that just, the inertia to make a change, right, to do something because interest rates were so low for so long. I think your point is, I think the point of the article and what you've mentioned here, Jake, is that it's good to evaluate that, make sure that you're earning the interest on the cash. I also think it's good that they included in there that before, though, you are concerned with how much interest you are earning on cash, if you have credit card debt, that's really what should be prioritized initially.
Well, yeah, because our show last week, we talked about how credit card interest has jumped to 22%. So the bank's not going to pay you 22% on your cash. So as long as you've got an emergency savings built up, you need to go ahead and pay off that credit card.
Yep.
Good. A quick plug for Upticks. I didn't say this in the beginning, but I want to thank all of our subscribers. Our account continues to increase. So again, if you like this episode, please give us a thumbs up, 5-star rating, and share with your friends and family. We are producing Upticks in an effort to enhance financial literacy, and hopefully you're getting enough out of this show that you feel like you can share it with your friends and family. All right. Enough of my commercial, Corey. I've got another one here. What are real yields and why do they matter? Real yields, and this is another one from, guess where, Corey?
Wall Street Journal.
All right. Real yields, a measure of the stated return on treasury bonds minus inflation, climbed to the heights not seen since 2009. So just to give this in English, if inflation is 3% and a treasury bond's paying 5%, then the real yield is 2%. That's what this is saying. So based on a 10-year treasury inflation protected security, real rates, as they're also known, hit 2% actually in the United States before finishing August around 1.86%. So it says higher real yields are good news for savers, but the picture gets more complicated as they ripple through the markets and the economy. They reflect the fact that borrowing is getting more expensive, which tends to slow growth. And higher real yields tend to drive investors into cash-like products such as money market funds, like I just talked about, and out of riskier assets like stocks or cryptocurrencies or gold, or to gold, basically, which can have an economic impact also, especially if it goes on long enough. So I wanted to point out here, Corey, who benefits from rising real yields? Savers do, because again, you're getting paid interest on your cash. like money market and treasuries and CDs. Something, again, these products haven't done for years. Who doesn't benefit, though, from rising yields are some analysts have chalked up the stock market's August slump to rising real yields, which had often played a role in slowing bull markets. And there's a reason for this, that both from both the corporate and the investor points of view, as it costs more to borrow cash, some companies might struggle to stay afloat, and others might become less willing to finance new projects, a factor that could hurt future earnings and weigh on economic growth. For investors, higher rates mean a higher discount rate gets applied to future cash flows, making valuations in the stock market look a little bit more stretched. So to finish up here, what might happen next with real yields? Well, Jerome Powell, the Fed chair, said on August 25th that the central bank is likely to hold rates steady for now, though he kept the door open to raising them later this year if the economy doesn't slow enough. It says right now, odds of the Fed raising rates further are a coin flip in futures markets, and that's probably gone down since this article, where traders are betting roughly on a percentage point of rate cuts in 2024. So the takeaway here, Corey, rates are high for high rates are good for savers, high rates are bad for companies and maybe investors who are looking to take money out of the risk of the stocks and just go put it in a CD. What are your thoughts on this?
Yeah, I think it's magnifying the larger point of where we stand right now, which is that there has been more reward for savers than there has been in the past, and it's been more challenging for borrowers than it has been in the past.
So yeah, and we look at that real yield. So it's, again, your return. So if inflation was 5% and a treasury is 5%, that wouldn't be so tight on the economy. But because that's starting to widen a little bit, Corey, that's definitely something that we're paying attention to. Good.
Yes, and I do know just from reading a lot about it last year that as the Fed was raising interest rates in 2022, their perspective of getting to neutral or even restrictive monetary policy, it was interesting. A big point that the Fed focused on, Jake, was real yields. That the Fed really viewed, largely speaking, that when real yields or real interest rates were positive numbers or higher, that's really when monetary policy gets a little bit more restrictive as far as the economy goes. So that's what they've been aiming to do, is the point.
Got it.
All right. So next, Jake, the article that I have here is from the Wall Street Journal. Imagine that. And the headline is "The Generational Paradigm Shift Taking Over Markets," which is full of buzzwords in that headline, Jake, in my opinion. Generational paradigm, new paradigm. I'm always a little leery when I see those words, frankly. But the point in this article, the generational paradigm shift in taking over markets, is that for most of the 20th century, stocks and bond yields have moved in opposite directions. Bond yields going up has hurt stocks. Bond yields declining has largely been a tailwind for stocks to rise. But now, after about 2 decades of the behavior where stocks and bond yields move in opposite directions, now we're starting to see that reverse some, which is largely a byproduct of inflation. And what was highlighted in this story specifically is that, first and foremost, is going back to the article that you mentioned initially, Jake, around employment. And again, I'm sure that everybody can kind of understand, or is at least picking up on, how all of these things are interrelated and connected. But this particular story said that instead of taking it as a sign that companies see weaker demand and that consumers were less confident as bad for profits, investors actually welcomed the idea of a slowdown, which goes back to what you talked about earlier, Jake. If the labor force is not rising as quickly, which this was printed right around when that jobs report came out at the beginning of September, that the idea of a slowdown just means ultimately that there's less pressure for the Fed to continue to raise rates, which helps a lot of the markets and the economy, or at least removes a little bit of uncertainty. As far as this generational paradigm shift, though, Jake, they talked about how this is much different than the way that markets have operated, and that for most of the 20th century, aside from the Great Depression, World War II, and the Vietnam War, that stocks and bond yields moved in opposite directions. And now we've started to see that, again, sort of just revert back to the mean, if that's the way that we want to put it. The reality is we've seen bond yields continue to rise over the last 18 months or so. And we've seen stock prices move up and down, of course, but ultimately the point in all of this, and the reason I wanted to highlight it here today, Jake, is just simply that, the environment that we're in now is different than the one that we've been in before. But I just talked a lot, Jake. What are your thoughts about that?
Well, just your last statement. Every time it's different, so I get that, and I think it's fine. So again, I'm not I don't think you're concerned about this necessarily.
No,
So
no, I think it's more just, I think it's an observation, and it's important for people to understand. It really, Jake, because if you think about the last decade or two and the approach that people have taken to investing, my perspective is just simply that when the environment has changed a lot, just making the assumptions that everything that's worked for the last decade or two will continue working could be, that's just not ultimately the approach that we want to take. We want to be open-minded and evaluate as things change what that looks like. We don't want to be, having knee-jerk reactions to every data point that comes out. I just simply bring this up because the environment that we're in now is different than the one that we've been in. So if there's a lot of folks that are just expecting, more of the same or things to continue, the point here is that really hasn't been the case.
Well, and I think what's important though, Corey, is that in our financial plans, when we're looking at projections, we go back decades
to capture those.
To capture those. So again, even though it's not one we've been in lately, it's definitely not new for the market. So I think that's the other.
You don't think it's a generational paradigm shift?
No, I think that's why you stay diversified is the whole secret to this. And I think that's why we haven't, because you're saying that stocks and bond yields are now moving in opposite directions, and they haven't done that for 20 years. And so I'm saying that's okay. And that's a good reason to stay diversified. So,
all right.
Good. All right. Switching it back to personal finance. I found another article out there about Roth versus traditional 401ks and where to put your money for retirement. We talk about this a lot, Corey. There's lots of good information in this article. First, a quick definition, pre-tax, traditional in your 401k, it would lower your taxable income the year that you put in the 401k. But then when you go to pull it out of your 401k, it'll be added back in to your taxable income. A Roth is basically the opposite of that. It will be taxed before it goes into your 401k. But the good news is after you pull it out of your 401k, or when you pull it out of your 401k, it comes out tax-free as long as you hit all the qualifying events, age and reasons and whatnot. So I thought this was good. There is something new coming. It says that Congress will soon require older, higher earning workers to put at least some money into the Roth. And this law goes into effect in 2026. And people age 50 or older with salaries above $145,000 will have to funnel extra money that they do from the catch-up to a Roth 401k. And that's okay. We've talked about this with some clients, Corey, lately in our review meetings. And so again, I think, I don't want to go too much into the Roth versus the traditional because we've done previous shows on Upticks about this. But I thought here at the end of it, it said something to the effect that workers who want to contribute the maximum to a retirement savings account can accrue more wealth with a Roth than a traditional 401k. And the point of this is, Corey, when you're putting money in pre-tax, and let's say you have $1 million in your 401k pre-tax, well, it's not really $1 million because when you pull it out, it's going to be taxed to income versus $1 million in Roth. Yeah, you pay taxes out up front, but $1 million in a 401k that's in Roth is truly $1 million. So do you have anything you want to add to this? I know you talk about it a lot with your clients as well, but is there anything from this point of this article?
Just really the last point that you made, Jake, thinking about it in terms of spendable dollars. You're exactly right. As somebody retiring with $1 million in an IRA and somebody retiring with $1 million in a Roth, they have different amounts of money that they can ultimately spend, even though the value of an account or the portfolio might be the exact same because of taxes, which is why we talk so much about tax diversification.
All right.
All right. Next, Jake, what I have here is some more charts from Strategas.
When did you become such a chart guy? I don't take you as a chart guy. Are you a chart guy?
I am. Surprised you didn't know that.
Why do you? I personally am not a chart guy. I think charts are good for historical reasons, but I don't think they're good for predicting the future. What's your take? I
didn't think this was. That's interesting because my takeaway from this is not that any of these are really intended to predict the future. It's more that they were intended to show the data, but in a visual way, as opposed to a table or an Excel spreadsheet.
Well, give me a couple charts.
All right. So the first one here just talks about the story itself here that was published was must-see charts, Jake, for the last week of summer. And the first point that was highlighted here that I just wanted to bring up because I thought it was interesting is that nearly all the gains for the S&P 500, so this is just the broad index itself, has come following the failure of Silicon Valley Bank. We basically saw the market move higher at the beginning of the year, move back lower, but the vast majority of the market returns have occurred since that moment in March of 2023.
That's a good point because a lot of people would say, hey, Corey, I want to get out of the market. This bank collapsed and I don't know what's going to happen, but that's a good one. I like that. Good chart, Corey. Let's go to the next one.
All right. Thank you. The next one, the market remains heavily concentrated. I think this one tells a good story too, Jake, because it just simply is highlighting the combined weight of the 5 largest S&P 500 companies. Without going into all of the weeds about equal weight versus cap weighted in the index, the point here is the S&P 500, when we see the returns for that particular index, the size of the companies that make up the index itself can have either a larger or a smaller impact.
So are you saying from this chart, are you saying from this chart, 5 companies make up 24% of the index?
Yes.
Yeah, that's dangerous.
The combined weight of the 5 largest S&P 500.
So I would say that that's not very diversified.
No, it's not. And you're exactly right. My point in this, though, is that if someone is just investing their money into the S&P 500 and they're doing so passively, because that's become a popular way for people to invest over the last decade or two.
Well, it's a lot of way that a lot of advisors invest, which I think is wrong also. You know, buying buying S&P 500 funds for their clients. I think, again, they think it's diversified, but you're right. To me, it's not. If I told my client, I'm going to put 24%, you know, if you had $2 million and I'm going to put, Corey, a quarter of that in 5 stocks, they'd probably think that's probably me being a little pretty aggressive.
They might think you're a little crazy.
Good. What's our next?
If you said, I'm going to take a quarter of your portfolio and buy 5 companies, right? I mean, just the point is that's when people are passively buying the S&P 500. That's exactly what they're doing.
Right. Let's see the next chart here. Let's see the next chart here. We got a lot of charts.
All right, fair enough. You had enough. Okay. All right, on to the next chart. So the bond market has seen significantly more volatility this year compared to equities. And I thought this was interesting to see because a lot of people talk about the VIX, or that's being measured as the volatility index in the equity market. The point here is just that the bond market has had a lot more volatility this year than the equity market has.
Yeah, and the good news for our clients with bonds, Corey, is that they are holding them typically to maturity. So even though your bond may be down in value, and that's why, Corey, because when the Fed jumped up interest rates, of course you're going to have volatility in the bond market. But again, as long as you hold your bond to maturity and the entity that issued the bond remains solvent, the volatility doesn't matter because you'll get your face amount paid back to you. So key with bonds too is you don't necessarily need to panic sell them. You know, we don't typically sell bonds unless we can capture a gain or the client needs money or we see the risk has elevated. So we will manage bonds, don't get me wrong, but I thought that's good though, to see the elevated volatility. You got more charts, Corey. You got so many charts. Go ahead. Let's go to the next one.
I know there's two more quick
Too many charts.
They're must-see charts, Jake, for the end of the summer.
Whatever.
The next one was consumer stress is on the decline, but remains elevated compared to the last 30 years. I just thought this was interesting to see, particularly to understand the consumer stress is the way that it's measured over the last few years, because they're evaluating basically the price of groceries, mortgage rates, and gasoline prices to get a bigger picture of what consumer stress looks like.
So are they saying that this number is higher than the normal?
Yes. Yeah. Compared to the last 30 years, but it's a lot lower than where it was last year.
Yeah, that's true. I like that. Yeah, it has dropped, but it's not that much. I don't know. This chart's not must see. Let's go to the next one.
All right, fair enough. The last one here, the real Fed funds rate, which you talked about earlier, Jake, the real Fed funds rate is still below levels when recessions have historically began. Because the reason I thought this was useful to include here is that to this point, in calendar year 2023, it's largely been, everybody's been waiting for the recession that hasn't happened. And it really started with a lot of recession predictions back in late 2022 for this calendar year. But the reason I thought this was helpful to include here is just to show that the real Fed funds rate is still below the levels when recessions have historically began, when seemingly a lot of people's perspective of what's happening economically is different.
Yeah, and still no predictor of the future. That chart's no good either.
All right, fair enough. Well, we'll trim down the must-see charts. Maybe
I like
all
your
must-see.
charts. I didn't know you were such a chart guy, but some of them do paint a good picture. For our visual learners out there, the charts can be good. But I want to again remind people that you can't use charts to predict the future. I know, Corey, that's not what you're saying. But good. Thank you for sharing these must-see charts.
You're welcome.
All right. On to the next topic. Parents have a new incentive to fund 529 plans, Corey. These are college savings plans that you can fund for typically your children or your grandchildren. But there's a new rule or new rules that took in effect in 2024 that will give owners of such accounts more incentive to fund them and give account beneficiaries a way to jumpstart their retirement savings. So basically, the gist of this, Corey, is that you now potentially, there's certain rules apply, but just to know, you now may be potentially able to convert a 529 plan for a beneficiary that doesn't get used to a Roth IRA. So again, there's all these different restrictions, and I'm not going to go into the details today, but I guess my point, traditionally, in fact, Corey, 17 years ago when I started in this industry, 529 plans were very specific, somewhat restrictive, and a number one fear for people is like, what if my kid doesn't go to college? What if my kid gets a scholarship? Whatever. And people were worried about putting money in 529 accounts because they didn't want the money to go unused. Well, now the point is the government has come in and said, hey, if you don't use it, there are some ways you can get that into a retirement account for your kid, which would be very cool. Thoughts on that one, Corey?
Yeah, I think though the article talks about how that's an incentive for someone to save in a 529, and I suppose that is the case. But my read on all of this since the new rules really have been released is that this isn't necessarily a way for somebody to start thinking about how to fund a Roth IRA for their kid for 15 years from now. This is ultimately this is giving people options for unused $529 as opposed to it being a planning tool that people should try to take advantage of.
Right. Good point there. Yeah, I don't want people to try to find this as a loophole to expose. No, it's something that you can use, like exactly what you said, for unused money. Good. Yep. What's your next one? I think we got two more to go here.
Yeah, so the next one here talks about valuations in the economy may favor value stocks. This, of course, Jake, I have a great chart to illustrate the point here. But this is a research study that was published by Vanguard, and it just highlights that the value growth relationship. And just to start by quickly defining those, I think the simplest way for people to think about that is growth companies are going to reinvest their profits typically into the company itself. In an effort to increase the valuation. Value companies more traditionally also oftentimes will generate cash flow, pay dividends. It's not as simple as whether or not a company pays a dividend to determine whether it's a growth or value company, but that's what I'm talking about, growth versus value. And growth has really been the story for the last decade with the big tech companies and everything else. But the CFA and the head of one of the research teams at Vanguard pointed out that the relationship is as extreme as it was in late 2020. And now, as then, investors in aggregate are very enthusiastic about growth stocks, notably technology shares, and seem to have limited interest in value stocks, including financial, industrial, and healthcare companies. And the chart that is displayed here is just simply highlighting some going back to the 80s when the relationship between growth and value has gotten really stretched. I think that this was a helpful visual to understand what's happened following those periods of times. And what I thought was really interesting, Jake, is that they noted near the peak of the tech bubble in 2000, where growth had meaningfully outperformed value, that over the next year or so, that value outpaced growth by almost 59 percentage points, almost 59%, which is huge, very significant. And they also talked about in 2020, another undervaluation preceded a return advantage of 46 percentage points in 20 months following COVID. Again, the point here is largely that when there is a lot of hysteria or hype about specific companies in the market, I think artificial intelligence is something we've talked about on the show and our webinar that's relevant. Not saying that artificial intelligence is not something that will have a meaningful impact in the future. It's just more about when everybody gets really hyped up about a handful of companies or valuations, when valuations for companies don't matter, which is some of what we've seen over the years, that oftentimes that has a tendency to snap back in the opposite direction. And that's something that we're mindful of when we invest money for clients.
Nah, I don't like this chart. It says prediction ratio on it.
I think, see, I like that because I think that they're
stupid.
showing.
It's dumb because you can't predict the future. I think the only takeaway from this chart is that you need to stay diversified. I think it's stupid for people to use charts to think that value is going to magically outperform growth. They don't know that. They don't know that. That's why we have both value and growth in the portfolio all the time. That's why I think these charts are worthless. What does it matter? It doesn't. You don't know that this is going to move forward.
Yeah, the argument I would make there though, Jake, is that the opposite is true too. Like if we say the best thing you can do is stay diversified, that's also, is that not a derivative of predicting the future?
No, we stay diversified because we can't predict the future.
Right. You're right about that. I think though, I think the broader point though is that we can agree to disagree, but I am not choosing to just completely dismiss it. Not that I'm going to say I'm going to go and do something crazy or anything to that effect, but I think it's valuable information for me.
I think a good takeaway though, and again, I think a good takeaway is that irrational exuberance, like you're saying, like these fads, they become over. It's almost like mini bubbles is what this chart is saying, which is fine. I don't like a chart that has prediction ratio on it, Corey. You could keep throwing them on here, and I'll keep telling you why I think they're bad. Keep
shooting them down. All right, we'll see. We'll see what we get next week. What have you got last year, Jake?
All right, nice to stir the pot up here at the end. It says Donald Trump has expanded his dominating lead for the Republican presidential nomination. We're a little over a year away from the election, and it's going to be coming up more and more and more, Corey. And this was, again, of course, what news publication was this in, Corey?
Wall Street Journal.
Wall Street Journal, and it says
no charts over there, huh?
They probably do. I just don't pay attention to the charts. I read the articles. So this article says the former president is the top choice of 59% of GOP primary voters, according to a new Wall Street Journal poll. He widened his lead by 11 percentage points since April. And they had when they tested a slightly different field of potential and declared candidates. Meanwhile, Florida Governor Ron DeSantis, Trump's top rival, is barely ahead of the rest of the field at 13% support. According to the survey, GOP primary voters overwhelmingly see Trump's 4 criminal prosecutions as lacking merit, and about half say the indictments fuel their support for him, which is kind of weird. But and in a hypothetical rematch of the 2020 election, Trump had 40% support among voters overall, compared with 39% for President Biden. Corey, where are you at right now? And again, we don't need to go into details with our political opinion, but what do you think's going to happen right now? Well, I mean, maybe not the winner, but what do you think's going to happen here in the short term with the candidates?
It seems like we're hurtling towards Biden versus Trump 2.0.
I hate to see that. I mean, again, say what you will about Biden or Trump, right or wrong. I just want to see some freshness in there. I want to see somebody in their 60s run for president. What do you think?
Or 50s. Or 40s.
Or 30s.
What if? I think that, though, the way that you feel about charts, Jake, is the way that I feel about political polls, which is that they mean nothing. And we've learned that after the last few years.
You're right.
Trump, the list goes on and on. The midterm elections last year was supposed to be a huge Republican wave. I mean, that's literally off the top of my head. 3 elections that have occurred since 2016, where the actual results and what the polls found were a whole lot different.
You're right. I think you and I talked about this, didn't we? Didn't we talk about
Probably, I'm sure we have.
These polls are so stupid because we thought, so there you go. I love it. Polls and charts we've confirmed are almost worthless. My thoughts, again, I would like to see someone younger emerge. I don't know if that's going to happen though. So you're right. It may be Trump and Biden again. It's probably a little too early to know, but they're running out of time, right? So if somebody is going to emerge, they're going to need to pick up the pace here pretty quickly, start raising a lot of money and start campaigning. So we'll see. For our listeners, again, regardless of you're Democrat or Republican, I typically like whoever's going to make the market go up. So whatever that looks like, I'm pretty neutral as far as Democrat or Republican. I just, I want America to be the best place to live on the planet. And I want Americans to unite together. And I think whatever politician can get that point across, hopefully will win. But that's not always the case. Got any closing remarks on that?
Yeah, I've got to give you a quick shout out, Jake, and I got to give you credit here that, and the reason that I say this is because the comment that you just made about your neutrality towards politics is, I don't know a better way to say it than that might be what some people think that you would say on a podcast like this that you're recording. But I'm just simply making my point to say that we've worked together for, literally every day for, my entire professional career pretty much. And I got to give you credit there that you do truly, I know from working with you that you are neutral and see the good and evil on both sides. And I got to give you credit there because I frankly think that is what I would ultimately be looking for. Frankly, if I was hiring an advisor, I wouldn't want somebody with such strong political views that it's going to drastically alter the way that they approach managing and investing my money.
Well, thank you, Corey. That's nice of you to say. And I wasn't necessarily, maybe I was raised a little bit that way, but I also, I've trained and read and studied a lot about this. And it's not even just political, it's humans have different worldviews, right? And I think that's probably come from literally having thousands and thousands and thousands of meetings with amazing clients over the years and realizing that some of them are very strong in their beliefs and it doesn't make any of them right or wrong. And I like to see all viewpoints. And I think there's a shadow is what I've been taught. There's a shadow to all worldviews and there's a light, right? And it's what I'd love to see is the light come together, but good luck.
No, Jake, it's good and evil, bad and good. That's it.
A lot of
no in between, no middle ground.
That's a lot of people think. Well, thank you, Corey. Thank you for letting me shoot down your charts. I think they were great, though. I want you to keep bringing them. I'll keep shooting them down, but I think there was a few good ones in there today. And I'll try to be more diverse with my reading. That Wall Street Journal, though, man, it keeps just kicking it in. Keeps kicking. And there's some good articles. Like, again, I think we shared some good ones today.
Absolutely.
So, well, thank you again for joining me, Corey. And thank you all for tuning in. We hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.